The most basic and important factor stock investors need to know is the company's performance or earnings. April is the period when companies announce their quarterly results. Stock investors should look at the earnings and guidance of the companies they are interested in, as well as recent stock price trends. Earnings are on the rise, guidance are good, but stock prices were not going up or down recently. That is the best stock to invest. Nowadays need to give an attention in IT and healthcare field. This graph is the earnings growth estimates for the first quarter of 2021 published by Zacks Investment Research. Earnings growth estimates are getting higher with each announcement. It means that as time goes by, the economic upturn in 2021 is expected to be higher. Looking at this graph, the growth rate in the second quarter is expected to be up to 50% or more. It can also be seen that the economic downturn caused by COVID-19 is turning into a recovery from the end of last year. In 3Q and 4Q 2021, both earnings and revenue growth are expected to be positive. The next item to look at is the exchange rate. Looking at this graph, the US dollar is gradually gaining strength in 2021. It also means that the outlook for the US economy is improving. In 2021, each country's exchange rate fluctuates. The US dollar rose 2.7%. That's much higher than other major countries. The steady decline in the U.S. unemployment rate also shows that the U.S. economy is recovering. This is the S&P 500 index over the past 1 year and the rate of stock price increase by each industry sector. The S&P 500 was up 74.78%. The energy sector rose the most and the materials and real estate sectors rose over 90% also. However, on a larger scale, the difference between sectors is not that big. It is the investor's job to look for sectors with lower share price gains than performance gains. From what I've found out, the performance in the technology and healthcare sectors has risen a lot and is likely to be good in the future. But stock prices are not up that much. For reference, take this article from CNBC. The title is "This chart shows why investors should never try to time the stock market." It is written by Pippa Stevens. The key points are these. Investors should avoid the impulse to time the market, new data from Bank of America shows. Looking at data going back to 1930, the firm found that if an investor sat out the S&P 500's 10 best days per decade, total returns would be significantly lower than the return for investors who waited it out. And the market's best days typically follow the largest drops, meaning panic selling can lead to missed opportunities on the upside. This is the table. Timing the market is difficult at the best of times for even the most experienced traders. Now, Bank of America has quantified just how large the missed opportunity can be for investors who try to get in and out at just the right moment. Looking at data going back to 1930, the firm found that if an investor missed the S&P 500's 10 best days each decade, the total return would stand at 28%. If, on the other hand, the investor held steady through the ups and downs, the return would have been 17,715%. When stocks plunge, a natural impulse can be to hit the sell button, but the firm found the market's best days often follow the biggest drops, so panic selling can significantly lower returns for longer-term investors by causing them to miss the best days. Remaining invested during turbulent times can help recover losses following bear markets. It takes about 1,100 trading days on average to recover losses after a bear market, noted Savita Subramanian, head of U.S. equity and quantitative strategy at Bank of America. Sometimes, as happened in 2020, the recovery is much faster. The data comes amid a boom in retail traders trying to find the next Tesla or GameStop pop, and as fast, data-driven strategies become more prevalent across Wall Street. But Bank of America noted simple investing for the long term can be a recipe for loss avoidance given that 10-year returns for the S&P 500 have been negative just 6% of the time since 1929. Of course, the data also shows the astronomical returns for any investor who correctly called the 10 worst days of each decade, to the tune of 3,793,787%. Additionally, excluding the 10 worst and best days would have registered a gain of 27,213%. But given the difficulty of precisely calling the peaks and troughs, the better bet is to simply stay in invested. Bank of America noted that factors including positioning and momentum typically outperform over the short term, but fundamental analysis wins over multiple years. Whereas valuations explain very little of returns over the next 1 to 2 years, they have explained 60 to 90% of subsequent returns over a 10-year time horizon, the firm noted. We have yet to find any factor with such strong predictive power for the market over the short term. Looking ahead, Subramanian envisions more muted returns, or about 2% per year for the S&P 500 over the next decade. Including dividends, returns stand at 4%. The forecast is based on a historical regression looking at today's price relative to normalized earnings ratio. The firm added that over prior periods of similar returns, including between 1964 and 1974 as well as from 1998 to 2008, there was a higher probability of loss, pointing to the merits of staying invested for the long haul. According to Goldman Sachs data, determinants of return variation is like this. Asset class selection accounts for 94%. Next, security selection is 4% and market timing is only 2%. Asset class selection occupies an absolute proportion. This graph shows the odds of making a profit if you hold a stock for 1 day in the history of U.S. stocks, to a profit if you hold it for 30 years. It is calculated based on the index, not a specific stock. What this table shows is that if you hold it for a long time, you're more likely to make money. Of course, if you buy and sell well on booming day, you will be able to make a lot more profit. However, such a time is difficult to match, and if you do not match it, you may lose a lot. In order to obtain a stable return through stock investment for a long time, it is much more advantageous to invest in the long-term perspective based on the value rather than trading through timing. Repeating. The most basic and important factor stock investors need to know is the company's performance or earnings. April is the period when companies announce their quarterly results. Stock investors should look at the earnings and guidance of the companies they are interested in, as well as recent stock price trends. Earnings are on the rise, guidance are good, but stock prices were not going up or down recently. That is the best stock to invest. Thanks for watching this video.